Today, we start with a major policy change that market experts had worried about, retirement planners had cautioned against, and millions of Americans had wished would never occur. A rule update that developed not through years of discussion, but within only a few months. Months that have left seniors rushing. Months that have disrupted retirement plans nationwide. Months that may significantly change how Social Security benefits are determined for millions of Americans. What the Social Security Administration announced today crossed a line that advocacy groups had strongly hoped would remain. And when that line shifted, retirees and their families did not remain quiet. They reacted with frustration, uncertainty, and requests for answers. For more than a year now, there had been indications, not official statements, not formal releases, only indications that the SSA was preparing something unusual. The Social Security Administration has been methodical, yes, but they have also been notably private in their methodical approach. Their policy revisions have followed a certain pattern, a consistency, almost a bureaucratic routine. But what triggered concern among retirement advocates this year was that the routine became silent. Financial analysts who track Social Security policy understand the indicators. The quarterly benefit adjustment notices, the annual COLA projection releases, the scheduled congressional hearings, the sudden absence of routine updates. All of that became quiet. And whenever the Social Security Administration becomes quiet, many expect something important is about to be announced. For months, advocacy groups like AARP, the National Committee to Preserve Social Security, and the Senior Citizens League had been asking for transparency. They wanted answers about possible changes to the benefit calculation formula. They wanted clarity on new earnings limit thresholds. They wanted explanations for the delayed COLA announcements. Instead, they received silence until today. Early this morning, the Social Security Administration released what they called comprehensive benefit restructuring guidelines, including adjustments to the primary insurance amount formula that had not been updated in over 3 decades. These are the kinds of structural revisions that the SSA only introduces when they are signaling something very specific. Long-term solvency concerns, benefit adjustment strategies, or broader program restructuring. Retirement experts didn't know which category this fit into, or whether it touched all 3 at once. But what they did know was that the SSA was changing its core benefit framework. And when a federal agency changes its benefit framework without extensive public comment, even by limited measures, every American nearing retirement pays attention. Here's what the 2026 rule change actually does. First, it modifies the bend points in the primary insurance amount calculation. For those unfamiliar, bend points are the dollar amounts that determine how much of your average earnings become your monthly benefit. Under the old formula, you receive 90% of the first $1,174 of average indexed monthly earnings, 32% of earnings between $1,074 and $7,078, and 15% of earnings above that. The new 2026 rule adjusts these percentages downward for new beneficiaries. It's not a dramatic reduction on paper. We're talking about percentage point decreases of 2 to 3% at each level, but compounded over a 20 or 30-year retirement. These modest changes can translate into tens of thousands of dollars in reduced benefits. The warning issued by financial experts today was not ordinary. It was not routine. It was not symbolic. It was urgent. Analyst after analyst in interview after interview described the SSA's move as consequential, poorly communicated, and perhaps most importantly, difficult to reverse for those who don't act quickly. But policy changes only achieve their full impact if beneficiaries remain uninformed. Advocacy groups did not allow that to happen. In fact, their response today was among the most coordinated we've seen in retirement policy history. Here's what we know. Within hours of the announcement, AARP activated its 38 million member alert network. These were not routine policy updates. These were urgent action bulletins, communications that AARP only uses when they believe immediate member awareness is required. The National Committee to Preserve Social Security filed formal objections with the Office of Management and Budget. The Senior Citizens League launched a congressional petition that gathered over 100,000 signatures before noon. Retirement planning firms across the country began contacting clients about accelerated filing strategies. This was not passive observation. This was active opposition. Tonight, multiple sources confirmed that the SSA's 2026 rule change affects several critical areas, including earnings limit modifications that had recently been adjusted upward for what analysts believe was political timing. The SSA announced these changes before most Americans could adjust their retirement timelines. They changed the full retirement age calculation methodology. They changed the spousal benefit coordination rules. They changed the survivor benefit integration formulas that were likely intended to simplify administration, but may also lower payouts. In other words, the SSA targeted the structural elements of benefit calculation, the components that determine how much money actually reaches retirees. This is what made financial experts' warning so urgent. The SSA's rule change wasn't just procedural, it was consequential. It represented the kind of systemic modification that could reduce lifetime benefits by $50,000 or more for average earners if left unaddressed. And advocacy groups, understanding that fully, responded with force, not recklessly, not impulsively, but strategically. They didn't file frivolous lawsuits. They didn't organize chaotic protests. They focused on the legislative process directly. They used public awareness channels precisely. Let me break down exactly what's changing and who it affects. Change number 1, modified bend points. The first bend point drops from 90% to 87%. The second bend point drops from 32% to 29%. The third bend point drops from 15% to 13%. Who it affects: anyone filing for benefits on or after January 1st, 2026 who hasn't yet locked in their primary insurance amount. Change number 2, earnings limit adjustment. The annual earnings limit for those below full retirement age increases to $23,400. However, the penalty for exceeding this limit increases from $1 withheld for every $2 earned to $1 withheld for every $1.50 earned. Who it affects: working retirees between age 62 and their full retirement age. Change number 3, spousal benefit coordination. Previously, a spouse could claim spousal benefits while delaying their own retirement benefit to maximize lifetime income. The new rule requires coordinated filing, meaning you must claim both simultaneously. Who it affects: married couples who plan to use the claim and switch strategy. Change number 4, survivor benefit integration. Survivor benefits will now be calculated using the deceased spouse's reduced benefit amount rather than their primary insurance amount. Who it affects: widows and widowers whose spouses claimed early. And here's where the story becomes even more concerning. Policy analysts now believe that the SSA's latest rule change was designed to test the awareness level of American retirees after years of declining financial literacy outreach. The SSA wanted to see whether seniors would passively accept reduced benefits. But instead, the opposite happened. Advocacy groups didn't stay quiet. They launched an information campaign that was so comprehensive, so rapidly deployed, that even the SSA noticed. You don't get the federal government's attention easily. But today, American retirees did. Retirement policy experts speaking with financial media under background rules described the SSA's approach as strategic ambiguity, a way to implement unpopular changes while minimizing public backlash. But advocacy groups proved today that they remain both watchful and organized. Their information campaigns were not only accurate, they were distributed so precisely that millions of seniors learned about these changes within hours of the announcement. That speed matters because it shows something important about modern retirement advocacy. It shows that seniors are not passive recipients of government policy. They are active participants in shaping their financial futures. As reports continued coming in throughout the day, we learned more about the scale of the rule change's impact. Financial planning firms carried out urgent client reviews, forcing rescheduled retirement dates for thousands. Tax preparers contacted clients who had been planning Roth conversions in the last 6 months. Estate attorneys operating nationwide reportedly revised survivor benefit projections used by families to plan long-term care. This wasn't just a policy adjustment. This wasn't just a routine update. This was structural reform. This was benefit framework transformation. And benefit framework transformation is the one thing retirees have struggled to anticipate since the Social Security Modernization Act discussions began. For every planning strategy Americans have developed, The SSA has responded with something that complicates implementation. Consider these numbers. 67 million Americans currently receive Social Security benefits. 10,000 baby boomers turn 65 every single day. The average monthly benefit is $197. Under the new rules, new beneficiaries could see $40 to $75 less per month. Over a 25-year retirement, that's $12,000 to $22,500 in reduced benefits. Remember, the SSA thought Americans wouldn't notice incremental changes. They thought retirees would accept benefit modifications without questioning methodology. They thought advocacy groups had lost their mobilization capacity. But today, the exact opposite is happening. Americans are paying attention. Retirees are demanding explanations. Advocacy groups are coordinating responses at unprecedented scale. This is not the passive acceptance the SSA anticipated. This is active engagement. This is informed opposition. This is democracy in action. What makes this moment so significant and so consequential is that the SSA's latest rule change happened at a time when the Social Security Trust Fund is under maximum strain. Deficit hawks want benefit reductions immediately. Progressive advocates want payroll tax increases on high earners. Moderate politicians want gradual adjustments spread over decades. And retirees want their promised benefits protected completely. The SSA commissioner is balancing these demands while facing a 2034 trust fund depletion deadline. And when administrators in that position make sudden moves, they're not doing it from strength. They're doing it from pressure. They're doing it from political necessity. The trust fund currently has approximately $2.88 trillion in reserves, but it's paying out more than it takes in. By 2034, without changes, the fund may only be able to pay 77% of scheduled benefits. Today's rule change is intended to extend that timeline, but it does so on the backs of future retirees. The SSA's official statement, now distributed to every major news outlet, was designed to indicate that the administration is not willing to allow trust fund depletion without intervention. Officials said plainly that the current benefit trajectory was inconsistent with long-term program sustainability. That is bureaucratic language for benefits needed adjustment, and officials chose a limited notice approach. You don't usually hear that tone from the SSA unless something serious is at stake. But buried in the announcement was critical information that every American needs to understand. Grandfather clause. If you file for benefits before December 31st, 2025, you lock in the old formula, delayed retirement credits. These remain unchanged at 8% per year past full retirement age. Disability benefits not affected by the 2026 changes. SSI benefits, separate program, not affected. Meanwhile, leading retirement experts addressed the public in urgent direct terms tonight. They said, if you're between 62 and 70 and considering filing, recalculate everything. They said, if you're married, the spousal coordination change could cost you thousands. And they said, if you're a surviving spouse, review your options immediately. These are not theoretical concerns. These are actionable recommendations from professionals who understand just how high the stakes have become. Here's the consensus advice. Request your Social Security statement immediately at ssa.gov. Calculate benefits under both old and new rules using the SSA's online calculators. Consult a fee-only financial advisor before making any filing decisions. Consider filing before December 31st, 2025 if the old rules benefit you. Don't panic. Informed decisions are better than rushed ones. Here's what makes the situation even more concerning. The SSA's latest rule change wasn't isolated. Along with the benefit calculation modifications, Medicare Part B premiums also increased by 8.7% for 2026. The Medicare Part D prescription drug donut hole coverage gap thresholds changed. IRMA surcharge brackets for high-income retirees tightened. All of this happened within the same announcement period. When the federal government moves multiple pieces at once, it means something larger is underway. This appears to be a coordinated effort to address entitlement program sustainability. And while the policy goals may be understandable, the execution has left millions of Americans rushing. Financial analysts are now considering several possibilities. One is that the SSA is preparing for a larger benefit restructuring in 2028. Another is that the SSA is attempting to encourage later filing by making early retirement less attractive. A third possibility, the one worrying experts the most, is that the SSA is establishing precedent for annual benefit formula adjustments. But today, informed Americans took action. They didn't ignore the announcement. They didn't assume it wouldn't affect them. They didn't wait for someone else to explain the implications. They educated themselves. They contacted their representatives. They began making informed decisions about their retirement futures. What we're watching now is a test of American retirement preparedness. The SSA wants to see whether gradual benefit reductions will be accepted. Retirees want to show that they demand transparency and fairness. Congress wants to prevent electoral backlash. And advocacy groups want to prevent further erosion of promised benefits. The next 60 days before the grandfather clause expires will determine which side prevails. Tonight, we've heard from congressional sources who are now monitoring constituent response. They say phone lines are overwhelmed. They say email servers are at capacity. And they say the SSA's decision to implement changes with minimal notice is likely part of a broader strategy intended to reduce public opposition. But Americans are not accepting this quietly. In fact, Americans are responding decisively. Their response today, organized, informed, and determined, sent a message to the SSA that retirees are paying attention, and it sent a message to Congress that voters expect transparency. As the weeks go on, we expect more details to emerge about what exactly the SSA hoped to achieve with this timing. But what we do know is that the advocacy community's response was timely. It informed millions of Americans about changes that affect their financial futures. It provided actionable guidance for those approaching retirement decisions, and it held the SSA accountable for inadequate public communication. What happens next will depend on what Congress does in the next legislative session. If they modify the implementation timeline, this moment will be remembered as a victory for senior advocacy. If they allow the changes to proceed, Americans have already shown they are prepared. They have shown they are ready to make informed decisions. And tonight, for the first time in decades, the Social Security Administration appears to be reconsidering its communication strategy. Washington is quiet. Too quiet. And when the SSA is quiet after an announcement like this, it means they are evaluating. It means they are watching the response carefully. Because today the SSA learned something they should have known all along. American seniors are informed. American seniors are organized. And American seniors vote. This story is far from over. But tonight, one thing is clear. The 2026 rule change is happening. Your response to it is within your control, and your retirement future depends on the decisions you make in the next 60 days. And we will be here providing every detail as the next phase unfolds. Subscribe USA Move Guide for more latest update.